Strategy Management Series. Video number 84, Strategy Formulation. Step 7. Strategy Evaluation, Industry Attractiveness. Welcome back to the Ready MBA series on strategy management. In our previous sessions, we delved into strategy evaluation, the seventh step of the strategy formulation process. This stage entails scrutinizing potential strategies for their impact, benefits, costs, and resource requirements. To aid in this process, we introduced the Strategy Choice Cascade Framework, as outlined by A. G. Lafley and Roger L. Martin in their book Playing to Win. This framework assists the planning team in crafting coherent and impactful strategies that can be thoroughly evaluated. Today, our focus shifts to industry attractiveness, a pivotal aspect involving the assessment of different industries or market segments where the planning team aims to compete with the strategy being evaluated. This analysis seeks to identify and prioritize industries or segments with the highest potential for growth, profitability, and competitive advantage. During this phase, strategists analyze various factors influencing industry attractiveness, including Porter's 5 Forces framework, alongside considerations like market size, growth rate, profitability, regulatory landscape, and technological advancements. By conducting a thorough industry attractiveness analysis, organizations can make well-informed decisions regarding strategic focus and resource allocation, thereby maximizing their chances of capitalizing on the most promising opportunities. We will draw insights from the work of Michael E. Porter on industry analysis, competition, and strategy to navigate these topics effectively. Before delving into industry attractiveness, let's quickly review the topics we've covered so far to establish the necessary context and frame of reference. The Strategy Choice Cascade Framework comprises 5 sequential steps, each accompanied by pertinent questions that aid the planning team in formulating comprehensive strategies for evaluation. In our recent discussions, we've focused on exploring question number 2, where will we play? Which involves delineating key elements crucial for defining the strategic battleground where the company can realize its objectives. Who is the consumer? Which markets will we cover? Where will we compete? Which product will we offer? Which channels will we use? Building on our previous discussions regarding strategic targeting and understanding of consumer needs and wants, the planning team can discern the target audience and their specific needs to address. Subsequently, through segmentation and tactical targeting, they can identify the markets to be targeted. Understanding consumer motivation aids in elucidating why do consumers choose what they do, relative to the job to be done. In today's session, we'll pivot our attention to the third element, where will we compete? Elucidating how the planning team can delineate, assess, and choose the pertinent industries and markets in which they intend to compete. Consumer needs, or product scope, and geographic coverage serve as pivotal inputs to the industry assessment technique, which we will elaborate on shortly. The typical industry analysis comprises 6 steps, each contributing to a comprehensive understanding of the market landscape. Step 1. Defining the industry landscape. One of the crucial steps in strategy formulation is clearly outlining the boundaries of the industry. The planning team needs to carefully identify the product scope, consumer need, and geographic scope, determining what falls within the industry's realm and what lies beyond. This process requires thoughtful consideration to avoid common pitfalls. Leveraging Michael Porter's 5 Forces framework can be immensely helpful, ensuring a balanced industry definition that doesn't stretch too broadly or narrow down excessively. By examining factors like buyer-seller dynamics and competitive landscapes, the team can uncover differences that signal distinct industries with different attractiveness levels. Variations in how products are used, procured, or distributed reveal unique industry segments, each demanding customized strategic approaches. Similarly, differences in geographic coverage, whether it's international, national, regional, or local, further refine industry boundaries. Porter's guideline underscores the need for precision in delineating industry boundaries, enabling the development of strategies that resonate with the nuances and challenges of each segment. By carefully considering product and geographic scope and leveraging analytical tools like the 5 Forces framework, organizations can ensure strategic alignment with industry realities, strengthening their competitive position and profitability. Step 2. Defining key industry components. Examine the key constituents of each of the 5 forces and categorize them into relevant groups. Porter's 5 Forces framework scrutinizes the competitive landscape within an industry, highlighting 5 critical components for analysis: suppliers, buyers, new entrants, substitutes, and industry rivalry. Each element signifies a competitive force capable of influencing the overall industry profitability and how it is distributed among the different industry players. Step 3. Assessing the drivers of each force. Determine which industry forces carry substantial weight and which ones have less impact. Conduct a thorough analysis to derive valuable insights that can guide strategic decision-making more effectively. 1. Suppliers' power. Suppliers hold considerable sway when they possess the ability to dictate pricing terms, enforce quality standards, or offload expenses onto industry participants. This influence is particularly pronounced under certain conditions. Firstly, supplier groups exhibit dominance when they are more concentrated than the industry they serve, enabling them to exercise greater control over market dynamics. Additionally, if suppliers rely minimally on the industry for their revenue streams, they are better positioned to exert leverage in negotiations. Moreover, suppliers can bolster their influence by erecting barriers to switching, making it challenging for industry players to seek alternative suppliers. Furthermore, suppliers are deemed powerful if they offer distinct, differentiated products or services that lack direct substitutes in the market. Finally, the potential for suppliers to integrate forward into the industry poses a significant threat, as it may lead to increased control over the supply chain and heightened dependency among industry participants. 2. Buyers' power. Under specific circumstances, buyer groups can exert negotiation leverage, particularly when certain conditions are met. Firstly, when there are only a few buyers in the market or when each individual buyer makes substantial volume purchases relative to the vendors available. Additionally, industries characterized by standardized and undifferentiated products are susceptible to buyer negotiation power. Similarly, buyer groups may wield influence when switching costs between vendors are negligible or when buyers can contemplate producing the industry's products themselves by integrating backward. Furthermore, buyer groups are often price-sensitive in certain scenarios. This sensitivity arises when the industry's product represents a significant portion of their cost structure or when buyers operate with narrow profit margins, limited cash flow, or are under pressure to reduce purchasing expenses. Moreover, price sensitivity may be evident when the quality of the buyer's own products or services remains largely unaffected by the offerings within the industry. Lastly, if the industry's product has minimal influence on the buyer's overall expenses, buyers are more likely to prioritize price considerations. 3. Threat of entry. New entrants pose a threat by introducing additional capacity and vying for market share, which can drive down prices and escalate competition. Diversifying entrants, drawing from existing markets, can exploit established capabilities and cash flows to disrupt competition further. Incumbents facing high entry threats must either lower prices or increase investment to maintain their position. The potential reaction of established industry players can strongly affect the decisions of new entrants or those considering staying in the industry. If incumbents respond aggressively to new competition, it could reduce the profitability for newcomers, potentially below the cost of capital. Concerns about expected retaliation increase when incumbents have ample resources to counter newcomers, like extra cash reserves or significant influence over distribution channels and customers. Additionally, the possibility of price cuts by incumbents and slow industry growth adds to the apprehension among potential newcomers. Entry barriers are mechanisms that safeguard an industry from potential newcomers aiming to increase its capacity. These barriers encompass a range of factors. Firstly, supply-side economies of scale confer advantages to existing firms, allowing them to enjoy lower unit costs or more favorable supplier terms by producing at larger volumes. On the demand side, scale benefits emerge through network effects, wherein a product becomes more appealing as its user base expands. Furthermore, customer switching costs act as a deterrent, as buyers incur fixed expenses when considering a switch in suppliers. Additionally, significant capital investments are often required for new entrants to establish themselves in the market. Established firms also possess incumbency advantages, such as proprietary technology or brand recognition, which are challenging for newcomers to replicate. Access to distribution channels can pose hurdles, as newcomers may encounter difficulties in accessing existing networks, potentially necessitating the creation of new channels. Finally, government regulations can either impede or facilitate new entry, further complicating the landscape for potential entrants. 4. Threat of substitutes. Substitutes are alternative products or services that fulfill the same fundamental need as those offered by the industry but in a different manner. These substitutes often emerge unexpectedly, making them challenging to anticipate or identify. Due to their divergent nature, substitutes may not immediately appear as direct competitors to the industry's offerings. Despite their seemingly different characteristics, substitutes can impact an industry's profitability by imposing a price ceiling on its products or services. The threat posed by substitutes is heightened when they provide an appealing price-performance ratio and when the cost of switching from the industry's offerings to substitutes is minimal. 5. Internal rivalry. Competition among existing rivals is most intense when multiple competitors are of similar size and strength, leading to fierce battles for market share, especially in industries with slow growth rates. High exit barriers, such as specialized assets or strong management attachment to the business, can prolong rivalry even in the face of poor financial performance. Additionally, when competitors are deeply committed to industry leadership and lack familiarity with each other's strategies or goals, rivalry tends to escalate, often resulting in price wars that diminish industry profits by transferring value to customers. Price competition becomes prevalent when products or services are nearly identical, and firms face high fixed costs with low marginal costs, incentivizing price cuts to attract customers while still covering fixed expenses. Industries characterized by large, incremental capacity expansions, perishable products, or fierce competition on price alone are particularly prone to intense price competition. However, competition based on non-price dimensions, such as product features or brand identity, can enhance customer value and support higher prices, ultimately boosting industry profitability by meeting the diverse needs of different customer segments. Step 4. Evaluating industry dynamics. Take a step back and evaluate the broader structure of the industry. Identify the key forces that significantly influence profitability, recognizing that not all forces carry equal weight. Delve deeper into the most impactful factors within your industry. Assess whether your findings align with the industry's current profitability and its long-term outlook. Determine if the most profitable companies possess a stronger position relative to the 5 forces framework. This analysis provides insights into the fundamental drivers shaping industry profitability and helps inform strategic decision-making. Step 5. Evaluating force dynamics over time. Examine recent and anticipated future changes for each force within the industry. Determine the direction in which these forces are trending and anticipate their potential impact. Consider how competitors or new entrants might shape the industry's structure in the future. By forecasting changes and understanding their implications, organizations can adapt their strategies to navigate evolving industry dynamics effectively. Step 6. Positioning relative to the 5 forces. Identify opportunities to position the company strategically in relation to each of the 5 forces. Look for areas where the forces are weakest and where the company can gain a competitive advantage. Explore ways to leverage industry changes to reshape the structure in favor of the company. By strategically positioning itself, the company can mitigate threats and capitalize on opportunities within the competitive landscape. After completing the 6 steps, the planning team will gain a comprehensive understanding of the industries in which they aim to compete. Industries characterized by strong forces typically exhibit lower profitability and are less appealing. Conversely, industries with weaker forces tend to offer higher profitability and greater attractiveness. It's important to note that changes in product scope or consumer needs to be addressed, and geographic scope can redefine industry boundaries, influencing the nature and intensity of industry forces, profitability, and attractiveness. With this insight, the planning team can revisit previous steps in the "where to play" stage to explore different targets, needs, and segmentation strategies that could lead to a more favorable industry structure. Additionally, the team can devise strategies to enhance the company's positioning within the current industry or make strategic investments based on anticipated industry developments in the future. And this concludes our episode about industry attractiveness to articulate where to compete. Please be sure to check our next episodes where we will continue to detail where to play step of the strategy choice cascade framework. Until then, keep strategizing. See you soon.